The history of blockchain and cryptocurrencies did not begin with sudden innovation or speculative frenzy. It began with distrust. When I trace this story back to its origins, I do not start with Bitcoin's price chart or digital wallets, but with a long, bruising history of broken promises embedded in money itself. Every monetary system rests on faith that issuers will restrain themselves, that intermediaries will act honestly, that rules will not change arbitrarily. Blockchain emerged not as a rebellion against money, but as a rebellion against the custodians of trust, shaped by centuries of financial crises, debasements, bank failures, and centralized discretion that repeatedly asked ordinary participants to believe and then disappointed them. Long before blockchain cryptography had already been quietly preparing the ground. During the late 20th century, mathematicians and computer scientists explored how trust could be replaced by verification. Public key cryptography, hash functions, and distributed networks were not financial tools at first. They were defensive technologies born from Cold War secrecy, internet vulnerability, and fears of surveillance. But embedded within them was a radical implication. Systems could be designed so that participants did not need to trust one another or a central authority. They needed only to trust math. This idea lay dormant for decades, waiting for a catalyst powerful enough to pull it into the financial realm. That catalyst arrived with the global financial crisis of 2008. Banks deemed too big to fail were rescued, while households absorbed the losses. Money was created on a scale once thought impossible, justified by necessity, but unsettling in precedent. Confidence in institutions survived, but it was scarred. It was in this environment, heavy with anger and disbelief, that Bitcoin appeared in 2009, introduced by the pseudonymous Satoshi Nakamoto. The timing was not accidental. The Bitcoin white paper was less a technical document than a philosophical manifesto disguised as code. Its opening problem was explicit: how to create electronic cash without relying on trusted intermediaries. Bitcoin's innovation was not any single component, but the way known ideas were assembled. Blockchain as a structure combined cryptographic hashing, distributed consensus, and economic incentives into a self-reinforcing system. Transactions were grouped into blocks, linked immutably, and validated by a decentralized network of participants who competed to secure the system through computational work. Proof of work was not merely a security mechanism, it was an economic one, tying honesty to cost. To rewrite history, one would need to outspend it. This was a direct inversion of traditional finance, where trust is centralized and enforcement is external. Early adopters did not view Bitcoin as an investment. They saw it as an experiment, even a protest. It circulated among cryptographers, libertarians, technologists, and those skeptical of state-controlled money. Its value fluctuated wildly because its purpose was unclear. Was it currency, commodity, payment system, or ideology? History reminds us that such ambiguity is common in early financial innovations. Gold was once ritual before it was money. Paper money was once suspicion before it was normal. Bitcoin occupied this liminal space, dismissed by institutions and misunderstood by the public, as Bitcoin survived attacks, scandals, and cycles of boom and bust. Its existence alone became its proof. Each year, it did not collapse, strengthened its narrative. But limitations became visible. Bitcoin was secure but slow, transparent but rigid. It could store value, but struggled to support complex financial activity. Out of these constraints emerged the next phase: programmable blockchains. Ethereum, launched in 2015, reframed blockchain not as money alone, but as infrastructure. Smart contracts allowed code to execute agreements automatically without intermediaries. This was not just a new asset. It was a new way to organize coordination, replacing legal enforcement with algorithmic certainty. This shift triggered an explosion of experimentation. Tokens represented access, governance rights, stable value, or pure speculation. Decentralized finance attempted to recreate lending, trading, and insurance without banks. Initial coin offerings mirrored early stock markets, chaotic and exuberant. Once again, history repeated itself. Innovation raced ahead of understanding, and capital followed narratives faster than fundamentals. Scams flourished alongside genuine breakthroughs. Fortunes were made and lost with breathtaking speed. Critics saw madness. Historians saw familiarity. This was not unprecedented disorder, but the typical adolescence of a new financial architecture. Throughout this period, one tension remained unresolved. Blockchain promised decentralization, but humans sought convenience. Custodial exchanges reintroduced intermediaries. Governance concentrated. Speculation overshadowed utility. The system oscillated between idealism and pragmatism. Each crisis exchange failures, hacks, regulatory crackdowns replayed an old lesson. Removing trust from code does not remove trust from society. It merely relocates it. The question became not whether trust could be eliminated, but where it should reside. As governments and institutions began to engage with blockchain, the narrative shifted again. What began as an outsider technology was gradually absorbed into mainstream discourse. Central banks explored digital currencies. Corporations experimented with tokenization. Regulators debated classification rather than dismissal. The rebellion entered negotiation. History tells us this moment is critical. Financial innovations that survive opposition eventually face co-option, and their future depends on whether their core logic is preserved or diluted. Blockchain and cryptocurrencies viewed through history's lens are not a sudden break from the past. They are the latest chapter in humanity's long struggle to balance trust, power, and money. They reflect recurring desires to limit arbitrary authority, to expand access, to encode fairness into systems rather than rely on virtue. Whether they fulfill these ambitions remains uncertain. What is certain is that they emerged not from technological curiosity alone, but from accumulated disappointment with how financial power has been exercised. And it is here, at this uneasy intersection of idealism and institutional gravity, that the story of blockchain remains unfinished, because the technology has already proven it can exist, but has not yet proven what kind of financial order it will ultimately reinforce or replace. And the next phase will depend not on code alone, but on politics, incentives, and memory as the experiment moves from rebellion toward integration, and the meaning of decentralization itself begins to shift toward what decentralization truly means in practice rather than in promise. As blockchain systems matured, the debate shifted from whether they could function to who would ultimately control them. History reminds us that every financial innovation begins by challenging power and often ends by redistributing it in unexpected ways. The printing press democratized knowledge, yet also empowered new authorities. Joint stock companies diluted individual risk, yet concentrated capital. Blockchain now faces the same crossroads. One path leads toward integration. Governments and large institutions adopt blockchain as infrastructure, embedding it within existing hierarchies. Central bank digital currencies borrow the efficiency of distributed ledgers while preserving centralized control. Corporations tokenize assets, not to decentralize ownership, but to improve liquidity and settlement speed. In this future, blockchain succeeds technically, while its original political ambition fades. Trust is not removed, it is repackaged. History would recognize this outcome as familiar. Most financial revolutions end not by overthrowing institutions, but by modernizing them. The other path leads toward fragmentation and resistance. Public blockchains remain spaces of experimentation, financial self-expression, and occasional chaos. Decentralized finance continues to challenge intermediaries, at the margins offering alternatives, where traditional systems exclude or overcharge. Here, volatility remains high, governance contested, and legitimacy uncertain. This is innovation in its raw form, messy, inefficient, but unconstrained. History shows that such spaces are where genuine transformation sometimes incubates, even if many participants are burned along the way. Between these paths lies the true struggle: governance. Code can automate execution, but it cannot resolve disputes about values, distribution, or legitimacy. Every major crisis in the crypto ecosystem, from hard forks to protocol failures, has revealed that human judgment re-enters where code ends. Decentralization reduces reliance on central authorities, but it does not eliminate power. It disperses it unevenly, often toward those with technical expertise, capital, or early access. This mirrors earlier financial systems more than its advocates often admit. Perhaps the most significant historical contribution of blockchain is not technological, but conceptual. It has forced a global conversation about what money is and who should control it. It has exposed how much of modern finance rests on layered trust and legal enforcement rather than physical scarcity. It has reminded societies that alternatives are possible, even if imperfect. In this sense, blockchain's impact resembles that of earlier monetary experiments that failed in form but succeeded in influence. They shifted expectations. As regulation tightens and narratives mature, cryptocurrencies are shedding their innocence. They are becoming financial assets, subject to cycles, speculation, and systemic risk. This does not mean they have failed. It means they have entered history. Gold lost its mystique once it became money. Paper lost its novelty once it became law. What matters now is not purity, but consequence. How will these systems behave under stress? Who will bear losses? Who will be protected? The unresolved question remains whether blockchain can reconcile its foundational promise, resistance to arbitrary power, with the realities of scale, security, and governance. History offers no easy answer. It suggests that technologies do not decide outcomes. Societies do. The future of blockchain will be shaped by how much autonomy states are willing to tolerate, how much risk individuals are willing to bear, and how memory of past financial failures informs design choices. If blockchain and cryptocurrencies endure, it will not be because they eliminate trust, but because they redefine it in a way that feels fairer or more resilient than what came before. And if they fail, their legacy will still matter, because they will have revealed the fractures in existing systems and forced institutions to adapt. Either way, they mark a turning point, not a destination. If this exploration of blockchain's history has sharpened your understanding of money and power, I invite you to subscribe and continue these financial journeys with me, and to leave a comment sharing whether you believe decentralization is a technological reality or a temporary phase before new forms of centralization emerge. Because history teaches us that the question is never whether power exists, but how transparently and accountably it is exercised.